Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. Looking at the latest data, there is just this staggering statistic that jumped out at me.
Oh, yeah.
Yeah. In May 2026 alone, the U.S. government spent $133 billion just on the interest for its national debt.
Wow. Just on interest.
Just the interest. That's a 44% increase from the previous year. And, all that capital is going just to service past borrowing. It's not building anything new. So today, we're doing a deep dive specifically for you, the listener, to demystify a topic that, it constantly dominates the news.
It really does. It's everywhere.
Right. And based on recent analysis from IMF reports, OECD projections, and bond market data, we're on a mission today to explain why those really scary multi-trillion-dollar headlines you see don't actually tell the whole story.
Exactly. And, it is great to be here. Right off the bat, I want to say we are not going to panic over those massive absolute numbers.
Yeah, good, because they sound terrifying.
They do. But honestly, the sheer size of a country's debt is often weaponized just to generate clicks. It doesn't really foster understanding. So instead of panicking, we are going to look at the actual machinery behind those numbers.
The mechanics of it.
Right, because the real story isn't just about the total amount owed. It's about, who holds that debt, in what currency it was borrowed, and the mechanics of the interest rates attached to it. Once you understand that machinery, the fear naturally fades.
Okay, let's unpack this because the media loves to throw out absolute numbers like 30-something trillion dollars.
Oh, absolutely.
And as a regular person, you hear that and just assume the country is completely bankrupt. But looking at just the total absolute debt feels like panicking over $1 million mortgage.
That's a great way to think about it.
Right, because if you make $50,000 a year, $1 million mortgage is going to mathematically sink you. It's a crisis.
Oh, for sure.
But if you make $3 million a year and you locked in your mortgage interest rate at, say, 2%, you are perfectly fine. I imagine a country's debt operates on a similar principle.
What's fascinating here is that your analogy captures the fundamental concept perfectly. Absolute debt numbers naturally grow as an economy expands over decades.
Just because the pie gets bigger.
Exactly. This is why economists rely on the debt-to-GDP ratio. It's basically comparing the size of that mortgage to the size of your national income.
Which gives you a much better picture.
It does. But, even that ratio is really just a surface-level indicator. The data from the recent IMF analysis shows us that the real stability of a country's debt depends heavily on three crucial structural factors.
Okay, what's the first one?
The first one is the mechanical relationship between interest rates and economic growth, specifically nominal GDP growth.
Right. And the report specifically points to nominal GDP growth as the benchmark. Let's unpack that mechanism quickly because I think it trips a lot of people up.
Yeah, it can be confusing.
When we say nominal growth versus real growth, we're talking about growth before you subtract inflation, right?
That is correct.
So if the economy physically expands by 2% and inflation is running at 3%, your nominal GDP growth is technically 5%.
Precisely. And that nominal growth figure is the crucial metric you have to compare against the interest rate the government is paying on its debt.
Yeah.
If a country's nominal GDP is growing at 5%, but the average interest rate on its debt is only 3%, the debt load is structurally stable.
Because the economy is out-earning the interest.
Exactly. The overall economic expansion, combined with that inflation, is essentially generating enough new tax revenue for the government to organically pay for the interest.
So the mathematical problem emerges when those lines cross.
Yes. If interest rates consistently stay higher than that nominal growth rate, the math flips entirely.
The debt starts snowballing on its own.
Right, it just compounds, regardless of what the government is actually spending money on today, unless they fix their budget, of course.
Man, that's wild. Okay, what's the second factor?
The second major factor is the average maturity of the debt. This is what we call duration risk.
Duration risk, meaning how long the loan is for.
Basically, yeah. If a government finances its operations primarily through short-term bonds, say 1 to 3 year Treasury bills, they have to constantly issue new bonds to pay off the old ones.
Right.
This process is called rolling over the debt. And if global interest rates suddenly spike, that government feels the financial pain almost immediately.
Because they are forced to borrow at those new, higher rates just to keep the lights on.
Exactly.
It operates exactly like having an adjustable rate mortgage that resets every 12 months.
That's a perfect comparison.
When central bank rates are near zero, it feels brilliant because your debt is incredibly cheap.
Mm.
But the second inflation hits and rates get hiked, your monthly payment shoots through the roof automatically.
Yeah, it hits you instantly. Whereas if you issue a 30-year bond, you buy yourself 3 decades of breathing room before you have to worry about higher rates. Duration provides a crucial structural buffer.
That makes a lot of sense.
Yeah.
So we have interest versus growth and duration risk. What's the third factor?
The third factor is investor trust.
Trust. Like literally just believing in the government.
Yeah, because bond markets are driven by sentiment and confidence just as much as raw math. If global investors doubt a government's political ability to manage its finances, or even just pass a budget, they will demand a higher interest rate to compensate for that perceived risk.
A risk premium,
Exactly. They need a premium to lend their capital in an uncertain environment.
which creates a vicious cycle, right?
Oh, completely.
The open market thinks you might struggle to manage your budget, so they hike your interest rate, which mechanically makes it much harder for you to actually balance your budget.
That's the exact dynamic we see playing out in the recent G7 bond market data. For high-debt nations, the rising cost of borrowing actively constrains their budgets.
It pulls down their overall economic growth.
Right. So, the structure of the debt dictates the severity of the risk. But when we apply this framework to the United States, the situation is entirely unique.
Because of the U.S. dollar.
Yes, due to what economists term an exorbitant privilege. Because the U.S. dollar serves as the world's primary reserve currency, and U.S. Treasury bonds function as the foundational safe collateral for the entire global financial system.
So we basically operate under different financial gravity than almost any other nation.
Exactly, we really do.
The demand is practically built into the architecture of the system. I mean, foreign central banks, global corporations, they literally need U.S. dollars and treasuries just to facilitate international trade.
They absolutely have to have them. They aren't just buying our debt as a speculative investment, They're buying it because it's the required plumbing of the global economy.
Right. And the data from April 2026 really confirms this entrenched demand. I mean, foreign investors purchased a net $103 billion in U.S. long-term securities in just that single month.
That is a massive number.
It's huge. And total foreign holdings of U.S. treasuries now sit at over $9.3 trillion.
Yeah.
But here's where it gets really interesting, and honestly where I have to push back a little based on the data.
Okay, let's hear it.
We have this tremendous privilege, sure. But under the current administration of President Trump, the U.S. is operating an economy that is currently booming.
Right, growth is strong.
We are near full employment. Yet, the U.S. is still running a massive 7 to 8% deficit compared to GDP.
Yeah, that is the reality.
Traditionally, you run large deficits during a severe recession to pull the economy out of a ditch, right? If the economy is already running at full capacity, shouldn't we be paying down the credit card? It feels like maxing out your limit while you have a great paying job.
I completely agree. And the data highlights this exact structural imbalance as our primary vulnerability. The risk for the U.S. isn't a sudden chaotic bankruptcy. We aren't going to just bounce a check tomorrow.
Right, no one's repossessing the White House.
Exactly. The real threat is what we call a slow squeeze. Because the government is running these massive deficits during an expansionary period, the Treasury has to constantly issue an enormous supply of new bonds just to cover the budget shortfall.
And bond markets are subject to supply and demand, just like anything else.
They are.
So if you flood the market with trillions of dollars in new treasuries, eventually buyers are going to demand a higher yield to absorb all that excess supply.
Precisely. And that is where the staggering statistic you mentioned at the start comes into play. As yields rise to attract buyers, the cost of carrying the national debt just explodes.
Wow.
By July 2026, the yield on the 10-year U.S. Treasury note reached the 4.5% range. And that shift was driven by these exact fiscal concerns regarding bond supply, combined with geopolitical fears and sticky inflation.
Right, sticky inflation, meaning prices are just resistant to dropping, even with central bank interventions.
Exactly.
So this exorbitant privilege we have acts like a massive, heavy-duty shock absorber against a sudden financial crash.
That's a great analogy.
But these sustained high deficits are basically wearing out the suspension over time. We aren't going to violently crash into a wall, But the ride is going to get incredibly rough as these skyrocketing interest payments start eating up the federal budget.
That is the pinch. Every additional $1 billion spent servicing the debt is $1 billion that cannot be deployed toward other essential things.
Like infrastructure or defense.
Right, or social safety nets. It creates a slow, steady crowding out of the future economy.
Man. To really understand how unique our shock absorber is, we can contrast it with what happens to high-debt nations that operate under different mechanical constraints.
Yes, let's look globally.
Looking at the recent OECD projections and bond data, we get a stark look at Japan, France, and the UK. Let's start with Japan because they are fascinating.
They really are an outlier.
They have a debt-to-GDP ratio well over 200%. By all traditional economic metrics, their economy should have collapsed under that weight decades ago.
They should have, mathematically. But Japan avoided a crisis because of who owns the debt and the currency it's issued in. The vast majority of Japanese government debt is held entirely domestically.
Oh, interesting. So not by foreign countries.
Exactly. It's owned by the Bank of Japan, local Japanese financial institutions, and domestic pension funds. And furthermore, it is entirely denominated in their own sovereign currency, the yen.
So they aren't reliant on the kindness of foreign investors.
Right. Which totally insulates them from the kind of sudden capital flight that often triggers sovereign debt crises in other markets.
But insulation clearly doesn't mean immunity, right?
Okay.
Because the data from July 2026 shows the yield on the Japanese 10-year bond hit 2.87%.
Yes.
Which, I mean, that sounds negligible to an American investor, but in Japan, that is a monumental tectonic shift. It's the highest level since 1996. So what is the mechanism driving that shift now, after decades of zero interest rates?
Well, it comes down to the mechanics of inflation and currency pressure. For years, the Bank of Japan aggressively bought their own government's bonds to keep yields artificially pinned at zero.
Yield curve control.
Exactly. But as global inflation surged and the yen weakened dramatically against the US dollar, they were forced to step back. They realized they can no longer endlessly print money to buy bonds without utterly crushing the purchasing power of the yen.
Ah, so there's a limit to the printing press.
Right. So yields are finally rising to natural market levels, and when your debt is mathematically that massive, even a shift from 0 to roughly 3% creates a tremendous immediate fiscal burden. The squeeze is starting for them.
Okay, so Japan is heavily insulated because they control their own currency. But what happens to a high-debt nation that surrendered its printing press entirely?
Yeah, that's where things get dangerous.
That seems to be the exact trap France is caught in right now. Their public debt reached 117.5% of GDP, but they don't control the euro.
They don't. The loss of monetary sovereignty completely changes a nation's risk profile. The European Central Bank controls the currency supply, not the French government.
Right.
If bond investors demand higher yields, France cannot simply mandate its central bank to print euros and buy the debt to suppress rates the way Japan or the US could in an absolute emergency.
Wow, so they are entirely at the mercy of the open bond market's trust.
Completely. Which makes the deep political divisions in France right now a massive financial liability.
Investor trust is shaking.
It is. If global investors don't believe the French parliament can successfully agree on a disciplined budget, they will demand a massive risk premium. In fact, projections show France's interest costs could hit 100 billion euros by 2029.
100 billion. That figure could potentially surpass their entire combined budgets for education and defense.
It's staggering. The stakes are incredibly high when you lag a sovereign currency. If the market loses faith in the political system's ability to govern, the cost of borrowing spirals out of control very quickly because investors know there is no central bank printer coming to save them.
That is terrifying. Okay, I want to pivot to the UK data because they seem to sit somewhere in the middle of these extremes.
They do.
They issue their own currency, the British pound, so they aren't trapped in a currency union like France. But their bond structure has a totally different mechanical flaw.
Yes, the inflation linkage.
Right. Roughly 25% of all UK government debt is directly linked to inflation. Mechanically, for our listeners, how does an inflation-linked bond actually function compared to a standard treasury?
Well, with a standard bond, the government owes a fixed nominal amount of money. If you buy a £100 bond, you get £100 back upon maturity, regardless of what inflation has done to the value of that money.
Okay, simple enough.
But with an inflation-linked bond, the principal amount the government owes is actively adjusted upward based on an official inflation index.
Wait, the principal itself goes up.
Yes. So if a bond is worth £100 and inflation spikes by 8%, the principal mechanically adjusts to £108. The government now owes more actual money, and the interest is paid on that new, higher principal amount.
Oh, wow. So the exact moment an inflation crisis hits your economy, the actual size of your national debt balloons right alongside it.
Exactly. It's an automatic mechanical trigger that they cannot avoid.
That is a brutal vulnerability.
It makes their budget incredibly sensitive to inflation shocks. And they suffer from a second vulnerability, which is market memory.
Market memory.
Yeah, bond markets have long memories, and investors vividly recall the fall of 2022.
Ah, the trust money budget.
Right. The UK government proposed massive unfunded tax cuts, and the bond market instantly revolted. Yields skyrocketed, the pound plummeted, and pension funds faced margin calls that nearly broke the entire UK financial system within a matter of days.
That event is just a masterclass in how quickly markets will punish a currency if they lose faith in the underlying fiscal policy.
It really is.
So, just synthesizing all this for our listeners, Japan is like borrowing heavily from your parents. They won't break your kneecaps.
Yeah.
But now they're demanding higher interest.
That's brilliant, yeah.
France is like sharing a bank account with roommates.
Yeah.
You can't print your own money, and
But-
nobody agrees on the household budget.
Right, and investor trust just plummets.
Exactly. And the UK has a giant adjustable rate mortgage right at the exact moment inflation hits, and the bank clearly remembers that time they bounced a check 2 years ago.
That synthesis captures the distinct mechanical risks of each nation perfectly, and understanding those mechanics is exactly how we answer the most important question. How does this actually impact the everyday investor?
Yes, exactly. Moving from global economics to your actual wallet.
Huh.
So what does this all mean? If the risk isn't the U.S. defaulting tomorrow, how should everyday people think about their investments based on this analysis? Because the instinct for a lot of people is just to panic, sell their stocks and hide their cash under the mattress.
Right, and if we connect this to the bigger picture, the most critical step is resetting your expectations of what a sovereign debt crisis actually looks like.
It's not a sudden collapse.
No, it doesn't look like a chaotic default where ATMs freeze and the government shuts down. It looks exactly like what we've been discussing. A prolonged period of higher long-term interest rates, increased currency volatility, and shifts in asset valuations.
So we need to prepare for the slow leak, not the explosion.
Exactly.
Mechanically, how do higher long-term rates impact everyday investments in the stock market? If the government is forced to offer a 5% yield on a risk-free Treasury bond just to attract buyers, how does that ripple through to a normal portfolio?
It fundamentally changes the mathematical foundation for everything. Investment valuation relies on discounting future cash flows.
Okay, break that down.
Well, if an investor can get a guaranteed 5% return backed by the U.S. government, they are going to demand a much higher potential return to take a risk on a volatile asset, like a tech startup or a growth stock.
That makes sense.
Growth stocks are valued heavily based on their future promised earnings. But when interest rates rise, the present value of those future earnings mathematically drops. We also see this immense pressure in real estate because higher government bond yields directly drive up the cost of consumer mortgages.
Which obviously cools demand for housing.
Exactly.
The data explicitly advises against making extreme emotional moves like you don't just liquidate everything and put it all in physical gold bars.
No, please don't do that.
National debt is a highly nuanced structural risk, and it requires a targeted structural response. So the key is diversification across assets that manage fiscal risk.
You need to build a resilient portfolio. That means holding a variety of asset classes that react differently to interest rates and inflation. For example, considering inflation-linked bonds, similar to the ones the UK issues, but from the U.S. Treasury, known as TIPS-SIC. Right. These mechanically protect your purchasing power if the government attempts to quietly inflate its way out of the heavy debt burden.
And I imagine focusing on real physical assets or high-quality cash flow assets becomes much more important in this environment.
It absolutely does.
You want companies that are generating actual profits and strong cash flow today, rather than companies promising massive growth 10 years down the line.
Because those future promises are heavily discounted by the market when risk-free rates are high, that is the exact mechanism you want to target. Global diversification is also vital.
Like holding international stocks.
Yes. Holding equities in companies across different geographic regions helps protect your portfolio against severe fluctuations in any single currency, including the US dollar. The guiding principle is this: you do not fear the massive absolute debt number you see in the headlines. Instead, you respect the risk of long-term interest rates.
Respect the risk of long-term interest rates.
Yeah.
That's an incredibly practical, grounded way to approach this topic. It completely removes the emotion and fear from those terrifying red headlines,
Exactly. When you grasp the mechanics, the anxiety fades and rational investing takes over.
which is the whole goal here.
It is. And before we finish, I want you to consider one final concept, which is the idea of trust. Ultimately, a nation's debt is simply the price of trust.
The price of trust. I like that.
When a government runs massive deficits, they are deliberately borrowing from the future to fund today's consumption. But as we saw with the projections in France, where interest payments might overtake the budgets for both education and defense, that borrowing has a profound real-world cost.
It forces a brutal conversation about opportunity cost.
Yes, every dollar spent on past debt is a dollar stolen from future progress. So the provocative question we all need to mull over is this: as these skyrocketing interest payments mechanically consume larger and larger portions of our government budgets, what future technological innovations, what critical infrastructure, or what vital safety nets are we quietly sacrificing tomorrow just to pay for the borrowing of today?
Wow.
The sheer size of the debt isn't the tragedy. The tragedy might be the future society we can no longer afford to build.
That is just a really powerful and sobering reality to end on. It bridges the gap between high-level macro finance and the actual fabric of the society we live in. Thank you so much for walking us through the machinery behind the headlines today.
It was a pleasure.
And thank you to you listening for joining us on this deep dive into the true mechanics of the global economy. Don't forget to subscribe and hit that like button.